Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. Hey, guys, it's Mark Eitel here, and this is the Mr. Mortgage Show. And, guys, you are in for a great treat this week. We're going to have some fun. We're going to answer your questions. We're going to dive into the data. You're in the right place if you want the data, not the headlines, but the real stuff, the data, the numbers behind the headlines. Where are things going? If you want the information, the tips, the tricks, the strategies, the answers to your questions so you can go out and make better real estate and mortgage decisions for you and your family will settle in. This is the radio show for you. You're in the right place. Guys, if you have questions or comments, call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen, my producer, is womanning the hotline. She'll get your questions on the air. If you prefer to shoot her an email, you can do that by visiting mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions or comments over to her that way, and she will read them on the air. All right, guys, a lot of data released this week. The market reacted to the Fed alluding that there may be another rate hike coming. And guys, we've been talking about it for months, so clearly the market makers don't listen to the show, or that wouldn't have been a surprise. But nonetheless, it did shake things up a little bit midweek, and I found it fascinating because he's all but said until inflation hits 2%, his job is not done. So that should not have been a surprise. It was noteworthy this week. We did see a little bit of a bump in the market because of that. So another data set that I found super interesting. It's almost like the sky is falling. Every week there's another sky is falling headline. And it was referencing the fact that mortgage applications have fallen to their lowest since 1996. If you listened to the show last week, that's not a surprise because we talked about the hangover effect of forcing via stimulus a bunch of activity that would have happened anyway into a short window. So if you take 5 or 7 years of consumer behavior and force it into an 18 or 24 month cycle because of low interest rates or the desire to relocate because of COVID, then it makes sense that this is going to take a while to shake out. And you couple that with a higher interest rate environment than we were when all this activity happened. It makes sense that we're going to be here for a while. And I think it's healthy that we stagnate for some time and allow the market to catch up to itself. And if you missed last week's show, I would encourage you to at least listen to the first 8 minutes. We compared this hangover effect that we're feeling now to the unintended results to the cash for clunkers in the auto industry back in 2008 or 9. So it's not a surprise, and I think it's to be expected, and I think it's healthy to let the market catch up for itself. It's got a hangover. Let it take some aspirin and eat some greasy cheeseburgers and sleep on the couch and shake this off and then get back to normal. So I found that fascinating. The lowest mortgage application since 1996. And that got me thinking, what was the most popular car in 1996? It was a green Ford Taurus with brown leather interior. The number one song of the year was the Macarena. I'm not even going to sing that one for you. That was infectiously annoying. That car probably cost you $18,000. Gas was somewhere between 66 and 84 cents. Tin Cup, Independence Day, Birdcage, and Space Jam, not to mention Jerry Maguire, were big hits at the box office. Man, I can't believe 96, that was Tin Cup. That seems like yesterday. I loved that movie. That was my inspiration for many, many rounds of golf. But anyway, I want to share something else with you guys. I had a super interesting conversation today. One other interesting data point in that article said that refinances are all but non-existent. And I found that interesting because that's not what I'm seeing in our practice. The REC, R-E-C, reduce, eliminate, and consolidate, that debt consolidation refi is getting a lot of attention right now because people are burdened by a lot of consumer debt. We talked about the credit card balances breaching $1 trillion, and credit card interest rates are in the high 20s in a lot of instances, and equity lines are up over 10%. And, a lot of people are upside down on their cars because they bought them at the wrong time, and they can't refi them or sell them or trade them because they owe more than they're worth. And because of all of that, people are looking to the debt consolidation loan. And I find it fascinating because people are super resistant to the idea because they've got this all-time low interest rate on their mortgage, right? And they don't want to let that go, and I get it. And I was having a conversation with a friend of mine today before I jumped on the air, and he and I have known each other for 100 years, and we, earlier in life, trained together. We worked out. We were in the gym 4 days a week. And he reminded me of a conversation that he and I had back then. We had just finished working out, and we were standing there talking, and there was another guy that was about my size, my height, my build, that started training about the same time we did. And man, that kid was strong. And I could never understand why he was twice as strong as I was. And the two of us, Dave and I, were standing there talking, and this guy walked by. And I didn't really know him other than to say hello. And I never let him know that there was any animosity or jealousy that I had towards him because of his strength. And I said something out loud. I said, man, I cannot believe how much stronger he is than I am. I just can't get it. I'm bigger than him, but he's so much stronger. And one of the trainers was standing there, and he started laughing. And he said to me, he wasn't laughing at me. He said to me, being strong is only impressive in here, in the gym, and in prison. How you look and how you feel is what matters everywhere else. On the beach, how you look is important. In life, how you feel is important. In here, yeah, it's impressive to be strong. And I thought, wow, that relates to the market that we're in right now. I was holding on to a vanity metrics in my mind that didn't matter. Yeah, the kid benched more than I did, but I looked great and I felt great. That's all I should be concerned with. I was hung up on a number that didn't matter. And I wonder how many people are hung up on the 4% interest rate, and they're proud to brag about that at the barbecue or at the pool or at the family reunion, but they've got a 28% interest rate on their credit cards, or a 12% interest rate on their equity line, or an 8.5% or 9% interest rate on their car payment, and they're struggling each month to make the bills, and they're hanging on to this vanity metrics. Because we're talking to people every week that have the opportunity to save hundreds, if not more. I just did a debt consolidation analysis for a client that's going to save over $2,000 a month. Those are real numbers. And yes, their interest rate is going to go up. It's going to go up from the 4s to the 6s, but they're going to save real money each month by shaking that vanity metrics. And guys, I'm not suggesting it's right for everybody, but I am suggesting that you look at what's important for you and your family, and don't get wrapped around the axle holding on to a number that's actually hurting you in the long run. So anyway, guys, you hear the music, you know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we're back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And you heard the man. You can get your questions or comments on the air by calling or texting 855-462-7292. That's 855-462-7292. Jen is womaning the hotline, and she will get you on the air. Or head over to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page. Click that email icon, and you can shoot your questions to Jen via email. She'll read them on the air for you. And I did check the hotline before we came back from that break, and someone brought up a great point, because before we went into that commercial break, I was talking about the debt consolidation refi. And somebody said, isn't it better to get an equity line and keep the low interest rate? And the answer to that question is yes, if you qualify for it. And if you have enough equity with the bank's loan to value ratio to pay off all the debt that you need to pay off. And the reason I say that is the banks have lowered the loan to value in a lot of instances and increased the credit scores. So with a refi, you could qualify in the 600s. With an equity line, you may need to be in the mid 7s or higher in some instances. So to answer your question, you bring up a wonderful point. That would be something I would look at. And assuming that there's enough equity and that you qualify, of course, that's a wonderful decision. But one of the key differences in how the debt to income is calculated with the refinance, we can take the payments of the debts that you're going to pay off with the refi out of your mathematical debt to income qualification ratios now. So if you're going to pay off a $300 car payment and a $500 equity line and a $500 or $600 credit card, all of that can be taken out now, so you qualify based on the lower ratio. And sometimes that makes a key difference, because the equity line is treated as new debt when your ratios are calculated. For a lot of reasons we can go into if anybody has any questions, but that's a key difference, which opens up a broader spectrum of possibilities for somebody with the refi over the equity line. So not pitching one over the other, because they both have their place and circumstances dictate which ones make the most sense. But great point, and I did want to reference that. Hey, Jen, go ahead and throw me a question.
Randy called this one in. I want to help my son and daughter-in-law buy their first home. Am I better off buying it as an investment property and renting it to them until they can buy? Or is there a better alternative? Thank you.
Hey, Randy, that's a great question, my man. And certainly going the investor route and renting it makes sense. I mean, that's an easy way to do it, because with the landlord loan, your income's not even evaluated, just the potential income from the property, your credit, and your assets. So that might be the path of least resistance. One other thing I'd like you to consider, though, is if you're comfortable with it, you could be a non-occupying co-borrower, and your son and daughter-in-law, could buy the property as their primary residence, benefit from the lower interest rate. You would have to put less money down on the property using a primary residence mortgage. You could even use an FHA mortgage. Interest rate's going to be better. Down payment requirements are going to be less. And they could file for homestead exemption on that property. So there's going to be a tax benefit as well. So I would look at non-occupying co-borrower. And then if that doesn't make sense or you're not comfortable with that, then you could certainly go the route of investor, rent the property, and you could even sell it to them with a gift of equity when you're ready to make that move. But brilliant question. And guys, we're seeing parents do this more and more, and we talk about it a lot on the air. We call it the first home layaway program, where parents are taking some of their newfound equity out of their property, buying an investment property, renting it out to a stranger, letting that person pay the principal down, build equity up, so that later, when their children are grown and ready to move out on their own, they can sell that property to them with the gift of equity strategy. So Parents helping children, grandparents helping grandchildren. It seems to be a theme of late. And I think with where the market is and where interest rates are, we're going to see that trend continue. So, Randy, I appreciate that question, my man. Hey, Jen, can we squeeze another question in?
Dominic sent this email. Is there an easy way to figure out if a rec refinance is the right move? It looks like we'll save around $600 per month, but I don't know how to figure out the blended rate.
Hey, Dominic, brilliant question, my man. There's a blended rate calculator I can send to you, but right out of the box, I think the answer to your question is, does saving $600 a month make sense? And I don't mean to be flippant with that, but that's a significant savings. And if your plans are to be in that property long enough that savings offsets the cost of doing the refi, then I think it's a no-brainer. But I would love to talk to you in depth about it. I wouldn't be too worried about what your current blended rate is, because it sounds like your monthly savings is going to be significant, and that might be all you need to make sense of this. So, but I would be happy to do the blended rate calculation for you, or I can send you the blended rate calculator if you're just curious to see what your actual cost of debt now is. But man, saving $600 a month, that's pretty attractive right now, my man. So, and guys, we put that website up, recrefi.com, RECREFI. And REC stands for reduce, eliminate, and consolidate. So RECREFI.com. And there is a debt consolidation calculator built into that website, and it'll give you a pretty good idea of the savings that you may or may not see. And I say may not because if it doesn't make sense, it'll tell you right in that calculator that there's no monthly savings benefit to making the move. So, and that calculator is there so you can see the numbers for yourself. Guys, the path is in the math. Don't get hung up on the vanity metrics. If it makes sense for you financially because of savings or otherwise, then yeah, run the calculator on that website and see what your numbers come back at. And if you have any questions about that, all my contact info is on that page. But guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, if you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. Jen is womaning the hotline, and she will get your questions on the air. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. She will read them on the air. She might have to edit out the bad words, but she'll read them on the air for you. We did get a couple of texts about I don't believe the skinny old man ever worked out. Anyway, guys, speaking of Jen and speaking of your questions, let's get into some more of that right now. Go ahead, Jen. Throw me another question.
Beth sent us this. My landlord is selling my house. He offered to sell it to me, but the price is crazy. Is there a certain amount of time a new owner has to give me before they can kick me out?
Hey, Beth, great question. We have seen a lot of this lately with where property values are that landlords are cashing out. The good news is that if you've got a lease in place and you're not in violation of that lease, in almost every instance that I'm aware of, the new owner will have to honor that lease. So you should be okay, but I would encourage you to, at very least, Google tenant attorney or legal aid and see if somebody can review your lease for you at no charge. Most of those places will do a no charge consultation. If you need help finding somebody, you can shoot us back an email and I'll help you locate somebody in your area. But almost always the new owner will have to honor that lease. Now, here's something that may or may not excite you. I've seen a lot of this recently where the buyer, if you will, the potential new owner, intends on occupying the property as a primary residence. Well, that means you, as the tenant, need to be out of there within the first 59 days of them owning it, or they're not going to qualify for a primary residence mortgage. In that case, the seller and the buyer may agree to buy you out of the lease and give you a lump sum of cash so you can move early. And I've seen some of these lease buyouts that are pretty impressive because the new person wants to get in there and the landlord wants to get out of there, and you might have a little bit of bargaining power. But at very least, you should be okay through the end of your lease, assuming that you're not in violation of the lease. And I would encourage you not to do anything to violate that lease if that new owner is going to have an itchy trigger finger to get you out of there. But if you need help finding somebody to review that for you locally, just give us a call or shoot us an email. Shoot us an email might be the easier way to do it. Go to mrmortgageradio.com, scroll to the bottom of the page, and just remind me of this conversation, and I'll try to find somebody locally for you that might be able to review that document. So great question. Hey, Jen, can you throw me another one?
Here's a text from Gerald. We ran up our credit cards helping my grandson get back on his feet, so we have a lot of debt. Can we pay these off with a reverse mortgage?
Hey, Gerald, great question. The short answer is yes, assuming that you've got enough equity and that you do qualify for the reverse mortgage. Then you can use that for just about any purpose that you want. So certainly to pay your credit cards off, that would work. So if you need more information about the reverse mortgage or you want to discuss specific details around your scenario, I would welcome a conversation off the air. But yes, you can pay your credit card, your consumer debt, just like the rec refi, you can pay all your bills off with the reverse mortgage, assuming that you have enough equity to make it all work. And I'd be happy to run some calculations for you to confirm that that indeed is the case for you. But brilliant question. Hey, Jen, do we have time for... Okay, go ahead.
Here's one from Cindy. We're looking at a few rental properties. If we transfer them into a company name after we buy them, will this affect the mortgage? Since the ownership is technically changing.
Hey, Cindy, you are very smart. You've been paying attention because you referenced the ownership structure changing, right? Technically, it's a new owner if it's now a company or an LLC, which is most common with investment properties. And you are probably alluding to the due on sale clause in most mortgages because now the owner is no longer the owner, it's now the company, and that could trigger the due on sales clause. And almost every residential mortgage has a due on sale clause in it. But here's something you may find encouraging. If you use a landlord loan or a traditional investor loan, most of them will allow you to close the loan in the name of the company now. There are some limitations on the company structures that are eligible, but LLCs seem to be the most popular with rental properties, and you can close the landlord loan in the name of the LLC, which may save you that step. Unless there's something in your strategy that I'm missing, if the goal is just to get it in the company name, it might be easier just to do that from the beginning and write the contract and close the transaction in the company name from the beginning, which the landlord loan has that eligibility for closing in a company name right out of the box. So might save a step and make sense for you. But great question. And I welcome the opportunity to discuss that in detail should you wish additional information. But I appreciate that one. Hey, Jen, do we have another one?
Michael sent this one in. We have the FSBOzilla book and the how-to guides. You made me laugh about the toilet seat. Any advice on a cheap way to turn the photos into a video to post online?
Hey, Michael. Thank you for checking out FSBOzilla and grabbing the book and the guides. And you're right. Who forgets to put the toilet seat down when you're taking pictures for your listing? It drives me crazy. The long strand of toilet paper that's hanging down, or the shower curtain that's left open, or the toilet seat that I don't understand that. Or the guy in his boxers with the beer belly who you can see his reflection in the mirror when he's taking the listing photos. That drives me nuts. So I'm glad you got a chuckle out of it. Guys, if you're curious what we're talking about, FSBOzilla.com is where you get the copy of the book. It's a how-to guide, how to best tackle the for sale by owner strategy if that is indeed your goal, to sell your property without a real estate agent. Just about everything you need will be there at the FSBOzilla website. So appreciate that, Michael. But to answer your question, there are several free services. The one that jumps right out to my mind is Canva. You can set up a free account at Canva, Canva.com, and upload all of the still photos and create a video from your still photos and even put some music behind it if you want to get super fancy. And if you need help with that, we can help. And we can also create the landing page that you can post online so that it all lives in one beautiful landing page with the video and the product description. We can do that for you too. I'm happy to help with that, but I would start with Canva and put that toilet seat down, folks. Anybody who's taking pictures of their house for sale, go through it. Look at what's in the background. Make sure everything is in order. Actually, if you're going to do it, just go to FSBOzilla.com. Download the book. The how-to guide will walk you through all the do's and don'ts. And the don'ts include leaving the toilet seat up. Don't leave the toilet seat up if you're taking listing photos. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Are you thinking of selling your home? Don't let realtor commissions eat away at your hard-earned equity. With FSBOzilla, you can save thousands by doing it yourself. Avoid the tire kickers and pushy realtors. Meet FSBOzilla, your free, no-strings-attached guide to selling your home by owner. You're a do-it-yourselfer, and we respect that. No more dealing with time wasters, tire kickers, or unqualified buyers, and definitely no more pushy realtors trying to snatch your listing. With FSBOzilla, you won't have to worry about showing your home to unqualified time wasters. We help you navigate the for sale by owner process safely and securely. FSBOzilla, the commission killer, putting the power back in your hands and the equity back in your pocket. Visit FSBOzilla.com today, FSBOzilla, because you can do it yourself and we're here to help. Check out FSBOzilla.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And guys, if you have questions or comments, just call or text 855-462-7292. Again, call or text that number. That's the Anytime Hotline, 855 462-7292, or head over to mrmortgageradio.com, scroll to the bottom of the page, click that email icon, and you can send your questions to us via email. Again, that's mrmortgageradio.com. Jen is standing by, womaning the hotline, taking the calls and watching for your emails and texts. She will get your question on the air. I'm laughing. Jen, did you see that? Guys, if you're watching this on Facebook or on YouTube, behind me on the Jumbotron, I've got the Rec Refi website up, and it's just at the still image of the video right now, but it's me, and the Jumbotron's pretty big, and it's like a real person, a life-size person is standing behind me, and I just caught myself out of the corner of my eye, and it scared the heck out of me. I guess I'm not as attractive as I used to be. I'm kind of scary looking in the Jumbotron. Anyway, guys, enough of that. Let's keep your questions and comments coming. Hey, Jen, go ahead and throw me a question, would you?
Nate sent us a question. How does buying a home with a reverse mortgage work? I heard you mention this last week, and it sounds interesting. It may be a solution for us. Thank you.
Hey, Nate, thanks for that question, my man. It is an amazing, amazing opportunity. And guys, I talk about reverse mortgages a lot. They're not right for everybody, but when they are life-changing because they don't require a monthly mortgage payment. So it makes a big, big difference for a lot of people. So Nate, congrats for catching that, because a lot of people miss the fact that you can use a reverse mortgage to buy a property. And the short answer is you'll put down essentially 50%. It could be a little bit less. It could be a little bit more. It depends on your age. But by putting that big chunk of money down, you now have enough equity in the property that you can start with the reverse mortgage. So if you're buying a $300,000 property and you put $150,000 down and you have a $150,000 reverse mortgage, you move into that property never having to make a monthly payment. You just make your taxes and your insurance payments at the end of each year. And if there's an HOA, you're responsible for that. But it is a difference maker for a lot of people. And where the home prices are now, a lot of seniors have so much equity. They never dreamed they were going to have this much equity. So if they're downsizing, they can sell the property, cash all that equity out, put a chunk of it in the bank, put a chunk down on a smaller property, and move into it with the reverse mortgage strategy and not have that monthly mortgage payment. Heck, you could even go a lateral move, and mathematically that may work out. So brilliant, brilliant strategy, a reverse to purchase. Not enough people even know it exists. Guys, if anybody out there wants to dive deep on a reverse to purchase strategy, please, I encourage you to get a hold of me or my office. I'll definitely walk you through how it would work. We can look at your exact scenario. One place you could start is moreaboutreverse.com, just to get the overall idea of how a reverse mortgage works, and then we could dive into the purchase strategy after that. So, brilliant question, Nate. Thank you. Hey, Jen, do you have another one ready?
Kaylee sent us this. My boyfriend and I are talking about buying a house together. Is there anything we need to watch out for since we're not married? Does it matter who is on the paperwork first, like buyer and co-buyer?
So this is a great, great question, and everybody should ask this question before they get started. So the whole borrower, co-borrower, buyer, co-buyer thing, it doesn't matter from the ownership structure. If there's two of you and you buy the property and the title's recorded as joint tenants with right of survivorship, then you both own 50%. If one of you dies, then you own 100%, or the other person owns 100%. It doesn't matter from that aspect. Usually on the mortgage application, whoever is the stronger borrower, meaning the better credit score or the larger income, would be the borrower and the other person would be the co-borrower. But the same applies. You both have the same responsibilities of the debt as borrower or co-borrower. So from that aspect, it's less relevant than most people think. The only thing I would caution you is to have an exit strategy, right? A lot of people don't realize this. So if two people buy and this goes for married people too, if you buy a property together and you're on the deed and on the debt together, The only way to get one person off of both of those instruments is to refinance them off the title and off the mortgage. A lot of people think a quit-claim deed is all it takes. And if boyfriend, girlfriend buy the property and break up, and girlfriend wants to keep the property and boyfriend wants to go move to California and, have an acting career, a lot of people think all boyfriend has to do is quit-claim deed himself off the property and off he goes. Well, he's still on the mortgage. So if girlfriend stops making the mortgage payment, they're both in default. Both of their credit scores suffer, and they both go into foreclosure. So that's the only thing I would caution you to be aware of, is if one person wants out, the only way to get them off both instruments is a refinance. A lot of people go the quitclaim deed route, and it comes back to haunt them in the future. So that would be my number one piece of advice. But I wish you well, and if you need some help along the way, please call or email us. I'll be happy to answer any questions and help any way we can. Hey, Jen, throw me another question.
Vincent sent this text. I want to use my VA loan for 100% financing and ask the seller to pay my closing costs. Can I do this so that I have no money out of pocket?
Hey, Vincent, that is a great question. And yes, you can do that, because the VA loan is going to give you 100% financing. So assuming that the seller contribution is enough to cover your escrows and your closing costs, you could get into a property with a VA loan with no money out of pocket. Now, that being said, in most instances, you have to put earnest money in escrow. And if that all shakes out mathematically like you intended to, you could close and get that money, all or a portion of it, back. So there is the ability to get into a VA purchase with no money out of pocket. So I would be happy to run the numbers for you if you want me to look into it. But the short answer is yes, sir, you can do that. Hey, Jen, throw me another question.
Here's one from Charlie. I show zero income on paper. I haven't worked in years, but I recently received a large inheritance. I could easily pay cash for a home, but want to keep my money invested. What, if any, mortgage options do I have?
Hey, Charlie. This is a great question, and we don't get this one very often. So there are 3 mortgage programs that may work for you. One is, I don't remember what the acronym is, but it stands for Ability to Pay in Full. There's a program that basically says if you can buy it for cash, we can finance a portion of it. And I haven't run the numbers on that program in a while, so I would have to double check what the down payment requirement would be. It might be 30%, but I would want to double check that for you before I give you a definitive answer. The other, which is a little more common, is the asset depletion income model. And don't let depletion scare you, because you don't have to sell any of your assets. But in underwriting, they take all of your assets and say, okay, if you had to live just off of the cash on hand, and stocks, IRAs, there's calculations for all of it, over the next 10-year period, if you've got $1 million, that's $100,000 a year. If that qualifies you, you can use the asset depletion income calculation. That's number 2. Number 3 is, it's called community. And if you've got adequate credit and adequate assets, then there's no income or employment verification for that loan. So those are the 3 things that jump right into mind. And in one of those 3 might be a solution for you. It's definitely not the wild, wild west of the early 2000s when all you had to do was be able to sign your name to borrow money. But there are some pretty interesting loan programs out there for this exact circumstance. If you got a load of assets and you've got decent credit, you're off and running. I say it all the time. There's 4 legs to a loan program, right? The property value, your income, your assets, and your credit score. Well, like any other table, it'll stand with 3 legs. And if income is not verifiable or employment's not verifiable, and you've got the other 3 pillars, if you will, of that loan, there may be an option for you out there. But anyway, guys, you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a one-bedroom, one-bath apartment for the last 11 years. That's right, one bedroom and one bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, if you have questions or comments, please call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline, and Jen will read your questions on the air, or shoot her an email, and you can do that by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can send your questions over to her via email. But speaking of Jen and your questions, I want to keep those rolling. Go ahead, Jen. What do you have?
Here's one from Jacob. I drive for Uber, Lyft, DoorDash, and Instacart, so I have 4 part-time jobs. Is it possible for me to get a mortgage? I make good money, but I read part-time jobs don't qualify for a mortgage.
Hey, this is an awesome question, and you are not alone. There are a lot of people who are killing it in the gig economy, making more than full-time income with app service delivery jobs. I'm super impressed with the industrious nature of the Uber drivers, if you will. I'm seeing some impressive income numbers. The good news is that you are going to be treated as a self-employed individual. And with as little as 12 months, preferably 24, but as little as 12 months, consistent self-employment history, you may be fine. We definitely have to deep dive this one. We have to look at the consistency of the income. The other route is to use a bank statement loan, and you can do that again with as little as 12, but it's easier with 24 months work history. So if anything has evolved out of this pandemic culture that we've lived in, there's a lot of liberal underwriting guidelines around this type of income, because in the past, you're right, self-employed income was difficult to use if it wasn't consistent. And I mean consistent, hourly, consistent weekly number of hours, and consistent weekly income for 24 months. The good news is that there are a variety of programs that now look past that. I would encourage you to move forward. Get a full income evaluation and see if you can't make this happen. So brilliant question. I appreciate that one. Hey, Jen, throw me another one.
Glenn sent this. I'm looking for a commercial loan to buy an old bank for my jewelry store. I've leased my location for 9 years. The bank will be perfect, and it has a safe and is much better location. Are there any mortgage options for this type of situation?
Hey, Glenn, that is a super cool idea, man. I never even thought about that. What a perfect jewelry store, because as you mentioned, the safe is already there. I don't know if anybody follows Patrick Bet-David online or watch or listen to his podcast, but they did something similar. They bought an old bank building and converted the vault into the podcast recording studio. It's pretty cool. But anyway, I love this question because there are several options. You are the perfect candidate for an SBA loan because you mentioned you've got 9 years history history in your current location, and you're now buying a place for your own to operate the business that you've got at least 9 years history. So assuming that the business throws off enough income to support it, you would be surprised to learn how liberal the SBA loan is from an interest rate standpoint and from a down payment requirement standpoint. This may be easier than you think. And the cool thing is you can take the remodeling costs and roll them into the loan. So it can be treated as almost like a construction perm loan. The most recent one we did was a manufacturer who had leased their location for years, and they bought a building and they had to gut the building to the exterior walls and rebuild the entire thing. Actually, except for the walls, they put a new roof, new windows, new everything, but they had to completely change the layout of the building. So the construction costs and the purchase price were calculated together, and they put a down payment down against that number, and they were able to draw against the loan just like a construction loan, and then it converted to a 20-year mortgage. So you are most likely going to be happy with the SBA loan program for this particular circumstance. So brilliant question, and I would welcome the opportunity to discuss it in detail. And congratulations, my man. It sounds like a very, very cool opportunity. Hey, Jen, do we have time for another one? Okay, go ahead.
Mary wants to know, we need a new roof and AC system for our house. The contractors have offered to arrange financing, but I wonder if an equity line or small mortgage may make more sense. What's your advice?
Hey, that's a great question. I would need to know a lot more information, but what interest rate and payment makes the most sense for you in this circumstance? That's how I would evaluate it. I would look at the contractor financing and say, okay, this is going to cost me X amount of dollars a month. They're charging X amount of interest. And I would compare that to either an equity line or the mortgage. That's the way I would evaluate it. Most likely the contractor financing is going to be a lien on your property, just like an equity line or a mortgage. So I don't know that there's anything different about that aspect of it. So for me, it would come down to term, interest, and payment, and which one you're most comfortable with and which one aligns with your long-term goals the best. So I hope that helps, and reach out if you'd like to discuss that in detail. Hey, Jen, throw me another question.
Wendy called with this question. We're very interested in your program for buying a kid's first home now. Can we do this for 2 homes at the same time?
Hey, Wendy, that's a great question. Yes, ma'am, you can. With the landlord loan, you can do that with multiple properties at the same time. So if you have 2 children and you've got enough equity or cash on hand to make that work, then certainly you could buy 2 properties at the same time, 1 for each of them, and you're off and running as real estate investors, and you're using that first home layaway strategy to ensure that your kids at least have an opportunity to make that move comfortably into their first home and not get priced out of the market. So great question. I appreciate that one. Hey, Jen, throw me another.
Here's one from Ashley. I've heard it's hard to get a mortgage on a house with solar panels. Is this true? It seems like such a good idea.
Hey, Ashley, that is a great question. It can be difficult. And where it becomes difficult is the cost of the solar panels are often financed, and nobody's taking into consideration that fact. So you have essentially a second mortgage. So most of them act as a second lien, or they're added to the tax bill. Where we see people have challenges with this transaction is the seller is unprepared to pay that off as part of the transaction, and they expect the buyer to be able to absorb it, which they can. However, it's adding to your debt to income ratio, and it's adding to the combined loan to value. You'll hear the term CLTV. So it's not as simple as you think. And I know every logical person out there is saying, wait a minute, why are you adding that to my monthly debt when I'm not going to have an electric bill? And I do find that ironic, but sadly, that's how it works. And that oftentimes is, in a nutshell, where the challenge is. The cost of the solar panels, that debt, is there enough equity in the transaction for the seller to pay it, Or will the buyer qualify for absorbing that payment in their debt to income ratio? And will the solar panel finance company approve the buyer and transfer that debt and subsequently sit in second position behind the new first mortgage that the buyer is using to buy the property? So if it sounds complicated, it's because it can be. And it's not cut and dry, nor is it as easy as it should be. But you're right. We do see that being a challenge in some instances. So you've heard correctly. It can be difficult. So anyway, I hope that helps. Hey guys, you hear the music? You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Man, time flies when we're on the air. I love doing the show with you each week. Guys, if you need us when we're not on the air, head over to MrMortgageRadio.com. That's MrMortgageRadio.com. All our contact information is there. The links to everything we talk about, MrMortgageRadio.com. Otherwise, we will see you next week right here, same time, same station. You guys have an awesome week. Be good.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.